Okay, let's continue to the target price based on the relative method. Relative method is using the industry ratio to come up with the target price. I'm not the quite fan of the relative method, but in order to get the sense of the average price based on the industry, then yeah, it makes sense. It totally makes sense. So let's calculate how to get this target price based on the PE forward ratio. PE forward ratio, industry ratio, we need to find that information from somewhere, right? So industry ratio, I found here some website like New York Stone's provided this ratio. So industries, computer peripherals, here we go. The forward for the P means we are using the net income in the next year. So 30.14. So I'm gonna use this 30.14. This is industry PE ratio of the computer peripherals. And then from ratio, we can calculate the price divided by EPS. Then how to get the EPS? Right, the following year's net income divided by number of shares outstanding, which is the EPS. So we got 34%. Very, they're similar. But if we assume that the company is following this average industry ratio 30 times, that means we are calculating the target price 30 now times EPS. Now it's not division, but the EPS times EPS, so that we can get the target price based on the industry ratio. Okay, so net income again divided by common stock, number of shares outstanding. So based on this industry ratio, we come up with $106 is the target price. We also can use the EV/EBITDA, also EV/EBITDA forward. EV/EBITDA concept. EV enterprise value of the firm right now divided by EBITDA forward. So industry, the ratio I've got is 24.76 from the New York Stearns. And then the firm ratio, we want to calculate the enterprise value is not the intrinsic value. Intrinsic value of this enterprise value of the firm. Okay, EV/EBITDA is the market value, right? The market value. So there you go. We're starting from this, okay? We're starting from this. Now divided by EBITDA, the following year's EBIT. We don't have information EBITDA here, but we can calculate by adding back this depreciation onto EBIT, right? So depreciation, there you go. So that is the EBITDA. We want to make a parenthesis. Then the firm's EV/EBITDA ratio is 28. So let's calculate the target price based on industry EV/EBITDA. The same way we use this times. Now we need to get this times minus. Now minus because the target price should be minus the market value of that end, right? There we go. Oh, sorry, this should be times EBITDA first. The EBITDA, where is the EBITDA? EBITDA, we need to calculate apt plus depreciation, right? Okay, we need to multiply this. Okay, so that we can get the enterprise actual stock price, the common stock price. Why? This E71, which is the industry EV/EBITDA ratio times EBITDA net income plus adding back depreciation, now we come up with EV. But EV is not the stock price. We need to subtract this market value of debt and preferred stock, right? So we got this stock, which is the market value of stock divided by number of shares. So that we got $105 if we use the industry EV/EBITDA ratio. Okay. So it's very similar as the intrinsic value calculation. Okay. Then you can just apply some average of these target prices based on the discount cash flow model or the relative method. But I want to stick on the discount cash flow model, okay? Because the company is not the average in the industry. Now, next is financial ratio analysis. Once you found the target price, and then you can deliver some investment, the proposals, okay? And then you put some additional information about the performance or some evaluation based on the financial ratio analysis. Do you remember the EVA, ROA, ROC, ROE, or industry coverage ratio? You can put any kind of the financial ratio analysis if it is helpful for investor in investing into this stock, because we have all this financial data. So I just put just a few the financial ratios part. So you may remember the interest expense times 1 minus tax rate plus net income minus WACC times book value of debt. So let me just calculate this. Interest expense of first year, interest expense, there you go. Interest expense, you can just calculate in that way. 1 minus tax rate, then plus net income, right? Net income. Then minus, now we want to subtract cost of capital, the charge of cost of capital from WACC. Now times, now open the parenthesis, the book value of debt plus book value of equity. Where do you get it? There you go. We put all this long-term debt and equity part is that for accumulate other the comprehensive income part. Then I believe we got it. Okay, then see what is the EVA. Economic value added is 34,621,000,000. That is the additional economic value added, right? From the cost of charge. Then ROA, ROC, ROE, you can use the formula, and then you can calculate the same way. Okay. Then on the final project, you should put the more ratios. Okay, that's it. See you in the next video clip, you guys. Oh, I think it is the last video clip we've done. Okay, guys, bye bye.